Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending August 2nd, 2024. So just maybe some housekeeping before I get going here. I will be a bit on vacation again next week, so August 9, there will be no economic review. We'll be back on August 16 with the next edition. So we've had a very busy week here in the US and in markets. Stock market had a tough week. Bond market had an awesome week since last Friday. We had a Fed decision, which was a non-event for the decision itself, but the guidance was very important. Has been moving market since Wednesday. We've had a very interesting week in earnings. Tech earnings were a bit disappointing on the guidance. There seems to be some AI impatience that is starting to happen in the market, so that is also at play. Economic data was lackluster, and markets are starting to think that, well, maybe markets are priced for perfection. And this morning we had the jobs report, which was way below expectations, and this is again creating lots of shock waves in the market. So let's start maybe with the markets at the close on Thursday. So here, picture will be widely different at the end of the day, but very positive week for bonds, negative week for stocks. Price of gold also up 2.5% on the week, and it's now the leading indicator here year to date in local currency. So strong year for gold as more uncertainty is brewing around monetary policy. So let's get right into it. The Federal Reserve, so there's a signal for a rate cut in September that is starting to happen. So it's not like it was clear that we'll be cutting in September, but what Mr. Powell said was that, and I quote here, Mr. Powell said that a rate cut in September is on the table, provided that inflation data continues to be encouraging. So stock markets reacted very positively to that on Wednesday with good reason. So if we're about to go in that direction, cost of capital will be lower and multiples for tech should be pushed higher. So of course it was all good news, but now maybe with the data that we've had for the rest of the week, realize that maybe it's not all good news. So maybe if we stay with the Fed here, so the chart on the left here, you have the picture. So rates went up very quickly. They've been going sideways for about a year. Now we're looking at the normalization of monetary policy. So rates will not go back to zero. They should go back to around 2.5 to 3% somewhere in 2026. This is still our call. How measured will the path be? Well, that's the big question now. The table on the right tells you the odds for every other meeting that we have coming up by the Fed post jobs report that we've had this morning. So as you can see, for September 18, the odds are higher by market expectations now that we have 50 basis points of cuts rather than 25 basis points. We think it's a bit too much. The door is never shut, but Mr. Powell addressed that and said, well, not really thinking about that for sure, and we need quite a catastrophe to start the rate cut cycle with 50 basis points. But there's lots of data to come again. We just had the non-farm. There's 2 CPI reports before September 18 and one more jobs report coming up, and all of the other indicators that are giving us hints on brewing inflation and what's going on in the labor market. So there's still plenty of time before the next decision, but the market now is very clearly in the camp that cuts are coming in September, and we will have 4 cuts in 2024. If you look at the December meeting, the highest probability outcome here, as expected now by market pricing, is 450 on the rate, so that would be 4 cuts. So market is seeing lots of cuts now, and maybe just go into the reasons first. Well, this week we had the ISM manufacturing report coming out. Manufacturing is hitting a roadblock for sure. The total index was expected to grow a little bit, but it fell from 48.5 to 46.8, so we're in contraction territory for manufacturing. And if you look at the employment component in the table on the right, went from 49.3 to 43.4 in one single month, just like going from pretty much neutral to recession level, just like this. So this grabbed the attention of investors, thinking that, well, maybe markets were priced for perfection. Maybe earnings growth won't be as stellar as one would think. So even though rates could fall, markets now are kind of recalibrating with this new information. And on the bottom line, you see the percentage of firms that are reporting growth. About quarter of the sectors that are surveyed by the ISM are reporting growth. We're at 50 just a few months back. So manufacturing is heading in the wrong direction. And this morning, of course, non-farm payroll is always a big report, big market impact. On the left, you see that we had the 114,000, so down from the last 2 months, pretty much the same level we had 3 months ago, but it was clearly below consensus, so created shockwaves in the markets. And on the right, unemployment rate rising to 4.3% from 4.1%. And we've mentioned that the SAM rule a few times in the previous year, but now this rule that tends to be pretty good at timing recessions seems to have been triggered. So the 3-month moving average of the unemployment rate is 0.5% higher than the 12-month moving average. So it's statistical, but still historically that has a pretty good record on timing the starts of recessions. So is the U.S. economy in recession? We don't think so. When we just looked at the latest GDP report, seemed still on track for growth at potential. So there's that. When you look at leading indicators, nothing is pointing towards anything that is crashing down, but you always have to keep a very open mind with macro data. Labor market is telling us that the economy is softening or normalizing. You can name it any way you want, but of course this all warrants caution. And over the next 2 months, data will be very important to see how the Fed will behave. And of course for markets, remember that we're just entering August, the lowest liquidity part of the year, so tend to see more volatility when you have macro surprises during summer months. So this is also at play here. Maybe closing with the road to the US presidential election. This is just a step report. We don't have a progress report, rather. We're still close to 3 months until the election. But two very important developments on the week. On the left, you have the predicted odds. So those are the better odds for who will win the election. Mr. Trump was way ahead of Mr. Biden, peaked at 70% around the assassination attempt and the Republican National Conference. But now, if you look closely on the chart on the left, Mrs. Harris just surpassed Mr. Trump in terms of better odds. So it's not polls, it's better odds. Talking about the polls, to have a fair view on the polls, you need to have lots of polls. You need to aggregate them correctly. You need to weight them correctly. And we still don't have enough of these from Real Clear Politics to give an advantage to Mrs. Harris. So when we aggregate the recent polls, it still shows that Mr. Trump is ahead. But very interestingly, and I just picked this one because it's from Bloomberg, it was convenient, but just to show that there are some very recent polls that are starting to show a swing towards Mrs. Harris. So maybe that this is telling us that the poll aggregators will slowly be converging towards maybe neck and neck, and then after that Harris in the lead if this trend continues. But this poll here, this precise one, was from Bloomberg, and as you can see, this focuses on the swing states, and Mrs. Harris came ahead in this poll in every swing states except Pennsylvania and North Carolina. And very conveniently, the two of the favored candidates for our pick as our VP would be Josh Shapiro from Pennsylvania and Roy Cooper from North Carolina. So that could also help continue this turning of the tables here to help Mrs. Harris maybe solidify this emerging lead that she seems to be building here. So again, 3 months to go until the election, which is an eternity in politics, so we can't infer much with this, but it's interesting to see how we have a race. It's much tighter than many expected when we were still wondering if Mr. Biden was gonna come out of the race or not. But good developments here for the Harris camp. So what we'll be watching next week in Canada, the S&P Global Services PMI, the Bank of Canada summary of deliberations for the latest decision in July. So we'll have a glimpse of what was discussed at that decision when they decided to cut rates. Net change in employment last month, it was a loss of jobs in the country. Unemployment rate was 6.4% last month, so we'll have a taste of that. And in the US, the ISM Services Index should be a bit higher at 51.3 in July. So always a pleasure to serve you. If you appreciate the content here, please share and join us back, not next week, but in 2 weeks.